All right. Okay, so a lot of the material that we're going to talk about today is from a book called The Millionaire Real Estate Investor Book. If you don't have a copy of that book, I would highly recommend it. Just really lays out the fundamentals, right? And lays out a model, which I think that's important. It lays out a model and what would this look like if your end goal was to create $1 million in passive income. So good resource.
Right. And another big piece we're going to refer back to this book is because this is all about criteria. And I've got to, now that we're under recording, just remind everyone, Tom and I were on a 5-hour Zoom call with the CEO of our company, Gary Keller, 2 days ago. And so we've got a lot of fresh notes straight off of his beliefs and practices and models. So the big piece about the Millionaire Real Estate Investor is, a lot of people ask, hey, is it a good time to invest? It's always a great time to invest. Tom and I do this class all the time. We're not just doing it at this time. So you really just never want to ask, is this the best time to invest? If you've got criteria and meets it, then you should do it. So investing is opportunity, good and bad markets.
Yeah. So we already kind of covered this, why y'all are here today. So I'm going to kind of jump ahead. We're going to, just share some of our thoughts about investing in money in general and what's going on in the market. So as far as why we like real estate, we'll get into the details of why we like real estate, the power of leverage. There's never been a better time to put debt on something right now with where rates are, and the power of leverage is really awesome. So we're going to talk about that. And then proven systems as far as what to buy, how to buy, forming your own criteria. We'll get into some of those details, but we want to, before we jump in, just background, Joanne and I have 2 kids, Carver and Willow. Carver is still in bed sleeping right now, as is his normal routine with homeschool. And Willow is at work. So that's kind of how those two work together. But we've been licensed. Joanne got licensed in 2001 and I joined her in 2002. And we have 8 residential properties. We've flipped some properties here in the past few months, and we also hold some commercial real estate space, as well as operate the Curtin team, residential real estate team, and we have Create Wealth Property Management Company as well. So, all right, enough about us. So we wanted to start with just some big picture stuff of what we're seeing in the market, and then we can talk a little bit more about the Atlanta market as well. Interesting trend that has been happening is that, as you see here, over 2 million single family homes have transitioned from owner occupied to rentals since 2009. What drove a lot of that is with the downturn, hedge funds came in, big Wall Street money, and they started buying single family properties when the market was down. Their original plan, as we know from talking with them, they were looking at maybe a 5-year horizon. They just saw the opportunity. Prices had gone down so much. They were like, hey, there's some money to be made here because we're sitting on cash. We can come in and buy them, rent them out for 5 years, 4 years, and then we're going to sell them. What they learned through that process is that there's money to be made by just holding them. That was making such great returns to their investors. They basically just turned into giant property management companies, and they're still, well, I don't know about today, but they've kind of pulled back here in the last few weeks. But even earlier this year, there were still a lot of big hedge funds in the Atlanta area buying hundreds of single family homes, and those are just off the table. as far as, meaning they're just planning on holding them, right? So, so
And
we've seen a big transition with that.
and if I can just interject real quick, looking at this chart, I mean, to put this in perspective from a buyer. So in the past, we've been in real estate 20 years next year, and it's always been, okay, an investor will pay less than the retail buyer, right? First time home buyer. Like that's always been kind of the thought. Well, only a few years ago, as you see here in this chart, only a few years ago, we started seeing a first time home buyer make an offer on a house, and they were bid out by an investor offering full price cash. So now you had the minute we saw first time home buyers and investors competing for the same house, we were like, oh, here we go. I mean, it just completely sucked inventory, and the inventory is still super low.
Mortgage rates, that I mentioned this at the beginning. There's really never been a better time to put debt on an asset. You can see historically, we're the lowest we've ever been. The rates are actually even a little bit less than where this chart ends with the 3.9. They're super low. And you can see kind of that average, historical average. We're well below that. So
yeah, and Gary said a couple days ago, the interest rates right now, I mean, they're artificially low. They're supposed to be at 5 right now. They're artificially staying low, and so that's what's, some buyers are like, oh, maybe I'll wait and great deals will come later. Well, you know what? So might the interest rates. So that's really the opportunity right now. And you can't time the market. You can't wait for something to go low. And we're not saying necessarily it will. We'll keep talking about that a little bit. The opportunity is in these interest rates. And I have to do a caveat. If anyone has a mortgage out there that's 4.25 or more, then you should refinance your house. And you can do that at no cost. You can reach out to Tom and I, and we can let you know how to do a refinance without paying a dime.
Just a little more on mortgage rates. So typically the 30-year mortgage rate follows the 10-year treasury rate. You can see the two trend lines next to each other. They basically follow each other. That changed a few weeks ago, where they didn't follow each other so much.
And that was even more of a reason people leaned into their lenders, because they were like, hold on a second, like, wow, what do I need to be knowing? So that's when the real fiduciary role of a lender was rewarded, because those lenders that had their pulse on how to really help a client were helping refinances.
This is the trend line here since June of 2018, where this goes through that third week in March. We're still pretty much right there around that 3.6 mark. So yeah, it's kind of big picture. 2008, 2009, people ask a lot about, are we going to see a dramatic drop in housing prices? We don't have a crystal ball, but we do know that, having lived through 2008, 2009, that was caused by a financial situation, right? Versus this, this is different, right? Nobody's been through this before, so we can't predict it. But what we do know is that the inventory is still very low, and supply and demand is really what drives pricing in housing, as with everything. In 2008, 2009, there was just a glut of inventory basically foreclosures and short sales that were happening. and that caused the prices to keep coming down and down because there was such a huge supply. With the way everything is right now, the inventory shortage is not going to end. New home builds are not keeping up. There's still more buyers than sellers, right?
The low inventory is not stopping. That is not going to stop. Low inventory.
So from a residential standpoint, we don't see that prices are going to be dramatically affected. Commercial might be a little bit different. That's a different dynamic. So,
okay. All right. So, well, here's a great slide about the .com 911 crash. So, annual home price appreciation. Even back then, appreciation was not affected. I mean, obviously the S&P took a dive, and yet home appreciation stayed stable. So that's really where these hedge funds and these behemoth investment firms learned real estate was the place to go. So they started to reroute and start investing in the product because of this slide right there.
Yeah. So again, what we saw in 07 through 09 was a housing and mortgage crash. In what we are seeing right now is not not a housing and mortgage crash. So the last thing, we wanted to just mention again, big picture, student loans are really part of the conversation now. That's one of the reasons that it's causing first-time home buyers to delay their purchase. Okay, so because they're essentially making a mortgage payment already with the amount of student loan debt they're carrying, they're having to delay that purchase. The average has gone up by 5 or 6 years from what the average first-time home buyer was purchasing at. And a big cause of that delay is because of the student loan that they're carrying. So it's creating a rental market and a rental pool of people that would normally be purchasing their first home. They're still renting, further down, and that is an issue that needs to be solved. But that's another conversation. So, financial wealth. I think that's why most people invest in real estate, and there's a lot of definitions about what is financial wealth, and this is just a simple one: the unearned income to finance your life's mission without having to work. So that's passive income.
Something that we've been doing with the kids during this COVID-19 era is we've been playing the game cash flow with our family, and that is the object of the game is to get out of the rat race by creating your freedom number through cash flow. And the kids have loved it. I'll tell you that right now. I mean, they love that game. And Carver, my son, is 14, and he's like, "Is that it? Is that what life's all about?" Like, it gave him like excitement, like, "Oh my God, I figured it out." So it's just the way he felt free learning it is how we feel when we're actually doing it.
Yeah. So this is from the Millionaire Real Estate Investor book, and it's just a way of looking at how the wealthy manage their money, right, versus people who are not wealthy. So if you're not using your money to work for you, then basically you're working, you're earning money, and then the first thing you're doing with it is consumption, right? So you're spending, and then whatever's left over, that cash, that's your cash flow, and then you're investing some amount of that that's left over after you consume. The wealthy do kind of the opposite. They invest first to create the cash flow and then use that cash to consume. So they're buying an asset, not the consumption object that they want first, right? So they're buying something that would produce cash flow and then using that cash flow to consume. And
Mhm.
then if the opposite of that is you consume first, and then maybe if I have anything left over, I'll invest. So it's just a way to look at it. Great analogy here with, let's say your goal is to create $100,000 a year in passive income, and you want to be able to save up to do that. So this example shows that you make $100,000 a year, and let's say you're super aggressive and you're going to save $30,000 a year of your 100,000. So first 10 years, you've then saved 300,000. After 20 years, you'll save 600,000. After 40 years, 1.5 million. So it would take you 80 years to save 2.4 million. And if you put that $2.4 million in the bank at a 4% return, that will produce 100,000. So when you look at it, you realize you just cannot save your way to create that return by putting money in the bank, because that return is so low and it's going to take you so long, right, to accumulate enough money to produce $100,000 in passive income. This is another way to look at it. So if you work for your money, right there, there's different ways you can allocate your money. So you can spend it, you can donate it, you can save it, you can invest it. If you're going to invest it, the two ways to do that would be to either lend it, which means you're lending it to the bank and the bank's paying you some money, or you can lend it privately, collect interest that way, or you're lending it by purchasing stocks, mutual funds, those kind of things. That basically means somebody else is controlling it. If you're active and you want to own it, then you're lending it, you're doing owner financing, or you're owning a business, or you're owning real estate. You control it. So either way, those things are going to produce returns, but the active side is where you're going to get the better returns. And that's really where your money works for you. So, all right, one more example, if that hasn't done it for you. This is just showing what it looks like to invest $100 a month over the course of 30 years and at different rates of return. So, most banks are going to be between that 2 and 4%. So after 30 years of investing $100 a month, you're going to end up with somewhere between $50,000 to $70,000. But on the far right side, you can see how big of a difference that makes at an 18 to 20% return. So obviously, the higher the return, the better, and that's what we want to go after, and that's going to come from those active investments. This is just why we like real estate, why we think, particularly in Atlanta, that it's a great market. Nationally, 11.3% of all the home purchases, this is 2018, we don't have 2019 yet, involved an investor as a buyer. In Atlanta, 18.5% of homes purchased were investors in 2018, so Atlanta's higher. Again, we see in Atlanta, because of the favorable conditions, the hedge funds, the big investors are still purchasing homes here. And that's why we see a higher percentage than the national number. Median distance from their primary residence of an investor was 20 miles. So most people, if they are an individual investor, are buying close to home. And of those who purchased an investment property, 73% had an annual income of $100,000 or less. What that shows, I think a lot of people's misconception is that you have to have a lot of money to invest in a property. That proves that that's not necessarily true. Atlanta continues to grow. We're seeing Population increase, which is good for the rental market. Employment growth, we have a good diversity of businesses here. So we're not dependent upon one business, and particularly when you have an event like this, it can affect one industry really heavily. And fortunately, we've got that diversity. We have seen steady rent and price growth, and above job growth rates as well. And the prices compared to a lot of the other cities that have similar, employment growth and population growth, our entry-level price is still very favorable. So, in comparison to the West Coast, the Northeast, Austin, Texas, places like that have seen huge growth, their prices have really gotten to a point that it's not manageable for a lot of people.
Which is why a lot of these big firms targeted Atlanta to buy all of their homes, like thousands of homes a year was their goal. So they've done the math on Atlanta.
So real estate is unique in that you can leverage it, meaning you can borrow money to purchase, unlike stocks, mutual funds, money markets. You're not able to borrow money, or if you did, it would just be a wash because you're borrowing the money at the same rate of return that you're getting. So that's one of the huge advantages. And real property, unlike a stock, will never go to zero. So there's always going to be value to it. And we have seen over time, as long as you hold on to that property, the market with real estate always returns, right? It may dip, but it's never going to go to zero. And if you just hang on to it, the value has always come back.
Yeah. There's a friend of ours in Florida who bought a property. It never appreciated. He ended up selling it. It did not appreciate from what he bought it for originally. But all of that time, the renter was paying the mortgage. He was depreciating the loan. He came out of there. So all of these years had gone away or gone past. He was left with all of this equity, and he'd only put a small percentage down to even buy the thing. So in the end, he completely came out ahead, and yet it didn't appreciate. So even if it is a zero appreciation, that all of that gain is still yours.
Yeah. So we say it's the most able investment because number one, it's accessible. Anyone can buy it. It's appreciable, which increases in value over time. Historically, values rise 5% every year. It's rentable, which is your cash flow. So it produces cash flow. It's improvable, so you can improve the property. You can always put sweat equity into it. You can get hands-on and actually increase the value of the asset. It's deductible, depreciable, and deferrable. So there's great tax benefits. I'm not going to get into all the details on that, but depreciation of the asset is a tax savings. And then when you go to sell it, you can do a 1031 exchange, which basically means you're taking that gain tax-free into another asset, or deferring the tax, but if done right, you never pay the tax on it. It's stable, so it's slow to rise, slow to fall. It's not going to surprise you, again, unlike stocks where you can wake up and there's just a 30% drop. Real estate doesn't act like that. It's a slow moving, so you can see these trends coming. It doesn't happen overnight. And it's livable, so at the end of the day, if everything goes down, you can move into it. You can move into your rental property if you have to. So this is an example of how advantageous it is to be able to leverage, meaning put a mortgage on an investment property in comparison to these other asset classes. So stocks, mutual funds, money market, if you're investing $100,000, it's going to cost you $100,000. Investment property, you're typically putting 20% down. So to buy a $100,000 property, you would have to have $20,000. Carrying costs, stocks, mutual funds are typically 1 to 4% in fees. With an investment property, your mortgage ideally is offset by the rent, so you shouldn't have carrying costs there, other than the occasional vacancy and maintenance. Assuming again that 5% appreciation, which is the historical average for investment property, and then stocks and mutual funds seeing that 8 to 10%, money market, historically 2%. When you do the ROI, your return on investment of the money that you put in after the fees, you can see investment properties 25%. I'm going to show in more detail on the next slide. That's a great return. That's a 1-year return, right? Your potential loss, again, this is a dramatic case, but of course with stocks and mutual funds, it could go to 0, so you could have 100% loss. Your money market is guaranteed by the government, so it's unlikely to have any loss. An investment property, again, that would be pretty dramatic to see a 40% decrease, but again, it's never going to be 100%. So here's the breakdown of that 25%, again, using the $100,000 example where you invest $20,000. Your return with the appreciation of that property is on the full value of the asset. So even though you've put $20,000 in, the property is worth $100,000. When it goes up 5%, that means it's increased by $5,000. $5,000 is 25% of $20,000. So to see that same kind of return in a mutual fund yielding 10%, you'd have to invest $250,000. So that just shows you the difference, with what you can do when you put leverage on a property. So there's really several advantages with putting that leverage on. This first one is equity buildup. So this just naturally happens, as we just have shown, 5% in a year. So over time, your equity is going to grow as the market, as the house price increases. Your investment, of course, remains the same, and your debt starts to go down as you're paying it off. At the same time, the equity is going up. So eventually you can own that property, the equity continues to go up, and you have no debt on it. The second part is your cash flow growth. Again, over time, and we've seen this quite a bit in Atlanta where rent prices have increased. So over time, the rent price goes up, your cost of the mortgage is going to remain the same. Your vacancy and expenses should be pretty stable and remain the same, but your cash flow continues to increase over time as rental prices just naturally appreciate. So why do people invest in real estate? Again, it's that less out of pocket. You can do it with 20% down. On top of that, you've got the tax write-offs that we mentioned, and then what we just saw, that net worth growth through the equity buildup, as well as the cash flow buildup. College education savings, we've got a friend of ours who has 3 daughters, and so his goal starting out was he wanted to own 3 houses, with the idea that if he bought a house for each daughter, around the time they were born, by the time they hit college, he would have options, right? He'd either have that house where it was producing enough cash flow to put towards his daughter's education, or he could just sell that house and use that money towards that education. It's really the best tool for college savings. And the funny part of that story is he realized that with having 3 daughters, he was also going to have 3 weddings to pay for. So his goal went from 3 houses to he realized he needed a house per wedding as well. So now his goal is 6 houses, one for college and one for the wedding. So tax write-offs, we've got, CPA we can refer you to if you don't have someone and you want to know more on this, but kind of an overview. Your operating expenses and mortgage interests are things you can write off. Your financing costs, any closing costs, fees associated with obtaining the loan. Depreciation is a huge one. I won't get into all the details there, but basically the cost of the asset, excluding the land. You divide that by 27.5 years, and that's your depreciation that you can take annually on your taxes. So it's really a phantom deduction because the house is not depreciating, yet the government allows you to depreciate it and take that as a deduction on your taxes. So that can be a huge tax savings for those who have income to offset. Capital improvements, so anything you do to improve the house. Personal property can also be deductions, and maintenance expenses, of course, are deductions as well. So a lot of advantages there.
Tom,
All right.
I have a quick question about the tax write-offs. Does that apply to your primary residence as well as investment property?
No, it does not. Just the mortgage interest would be the only one.
Okay, thank you.
Yeah. So we were going to break down just kind of the common types of residential properties that are out there, talk about pluses and minuses of each of these, and share with you our thoughts on what we like. The first one is the condo unit. The pro here is that typically they're going to be a lower price property. So lower entry price. Your maintenance is included, so you're not going to have to worry about a roof or paint and a lot of the other things you might on a individual home. The downside is your higher HOA fees. Typically it can range, anywhere from a couple $100 a month to, we've seen as high as $500, $600 a month. So it's really difficult to make cash flow with that. You only own a percentage of the land, so you don't really control the entire asset, of course. And less appreciation is typically the case. Condos tend to be the first to fall if there is going to be a downside in real estate, and they're typically the last to then recover from that downside. So
and the building can agree not to rent anymore, and then you're stuck without even being able to. So
yeah, you gotta watch that. Single family home, we really like a single family unit for several reasons. It's easiest to resell. You're typically surrounded by other owner occupants, so the neighborhood stays appreciating, and on average tenants tend to stay longer in single family homes. I can't tell you all the reasons, but usually they have more stuff, so moving is a little more difficult. They usually, if it's a family, they tend to get rooted in the community. They don't want to move around a lot, so that's good for minimizing turnover. The con is that you only have one unit, so if the tenant does move out, then you have 100% vacancy when it is vacant. Duplex, they tend to be kind of that balance of, you've got some owner occupants and you have some renters. It does tend to have higher cash flow than a single family home, just because the costs are a little bit lower. But in general, they're going to appreciate less, and there are going to be more rental units around those. The last is the fourplex or quadruplex. These tend to be much higher cash flow. You minimize the financial impact from a vacancy. If you have one unit and you've got four, so you're only 25% vacant, and you've got economies of scale, meaning if you replace a roof, you're replacing it on all 4 units. If you're having it painted, you're basically painting 4 units at one time. The downside is there tend to be more upkeep on these. There's more tenant damage, a lot of turnover. They just don't tend to appreciate much because you are 95% of the time selling to another investor, and they're going to obviously try to drive the price down as well. Tenant conflicts, that's just depending on where they are. There's a few of these that we've sold in Atlanta, and it's just the nature of the lower rental price, the lower income. You just have some headaches that can come along with that. So wouldn't recommend starting with the fourplex.
Well, and Gary, I want to stop on that because Gary said we were having good conversation about investing, and the big piece through that MREI book is, really look at investing with an appreciation and a cash flow. So you're looking for, that's the best investment when it's got cash flow and it's got good appreciation. That's just the best returns. So you need to know what you're looking for. We do have some people that are investing, they want to invest. And if we ask them if they had $300,000, what would they invest in? And they have no idea. They don't know how to answer the question. So if you don't know how to answer the question, if someone asks Tom and I, like, hey, if you had $1 million, what would you invest in right now? We pretty much have a clear answer for that. So if someone doesn't have a clear answer for where you would spend the money if you had it, then you might need to work on your criteria, because then it's crystal clear if the opportunity shows itself that you would be able to jump on it. If you don't know what you're looking for, how are you going to find it? So that investment in cash flow is very key for criteria. And if you don't have the criteria, the book will help you create that. That is how we created our criteria as well.
Yeah.
The MREI.
Yeah, and I would recommend to anyone that's getting started in this that geographically, I think it makes sense to focus in on an area. You can actually become an expert in a geographic area pretty quickly over a couple of months by just watching everything that transacts in that geographic area. Meaning, you pick a couple mile radius or a few neighborhoods that you really like, and you'll understand value after a couple of months of just watching it. And then, you'll recognize when something is an opportunity, and that's a big part of it. I like to share this because this is a real world example of the numbers and how they worked. We had shared this at one of our, when we were doing them in-person workshop, and we had shared this property. It was coming onto the market, and we shared it as what we saw as a great example of a good investment. So this person ended up purchasing it for $231,000. This is obviously a townhome, you can see by the picture. Had already been renovated, so there was pretty minimal repairs of $3,000. Were just a few upgrades that needed to be done, but most everything had already been done, so it was move-in ready. And we put it on the market for rent, and we were able to secure a tenant pretty quickly. So the carrying costs, that's basically about a little over a month while they were doing a few of the repairs. So they did put 20% down for the down payment. Their monthly payment was $1,180. We leased the property for $1,650. So they did get, they are currently getting $470 in cash flow on that property. We liked it for the location. It was kind of right there off 75, close to the Braves Stadium. For this person, it was their first investment property. They liked the idea that it had a little bit less to do with upkeep since it was a townhome. and the updates were already done on the inside. The downside will be that it, I do think it's a great area and it will appreciate. It's just not going to appreciate as much as a single family home would. This particular townhome community didn't have any amenities or anything like that. So it may just see less appreciation, or it will see less appreciation, but they were buying it for the cash flow. So, hey, Joanne, do you want to just talk? I know we already kind of touched on this, but I guess kind of coming back to this idea that.
Yeah. So this is, so the home price change, the last 5 recessions, 3 of them were not negative price changes in the recession. So, everyone was like, oh goodness, home price changes are going to be affected moving forward. We actually don't know exactly. So we can't claim that we know what we're going to be doing, but home price changes in the last 5 recessions were up. Now, 2008 was a housing crisis. This one isn't a housing crisis. So that means inventory is, and Gary said, it is not going to be going up. So the shortage is continuing. And when you've got shortage, you're not going to have prices really depressed. So that just is a very good foreshadow to explain kind of what happened with this.
Yeah, so what happened in 2005 through 2007 is, people refer to this as they were using their houses as ATM machines, right? So they were basically sucking all the equity out through home equity lines, and then that cycle continued, and then when prices dipped, that's what caused the housing crisis. So you can see how big of a difference it is right now, with how much lower the home equity already pulled out is. So we don't, again, that just kind of goes to, we don't know what's going to happen, but we don't foresee this being the same as what we saw back in 08. Joanne touched on this earlier. It's always a great time to make a great investment. So if you know your criteria, and a property meets that criteria, then you should buy it. I mean, it's that simple. So you have to have that criteria. Okay, what kind of return am I looking for? Does it meet that? Is it in the area or whatever I've determined? And then you recognize, meets my criteria, so it's a great investment, I should buy it. And there's
and a lot of the times that criteria, y'all, is like, what am I going to be paying per month, and what is the rent going to be? If I'm in the positive on that, that fits my criteria. I mean, that can be what your criteria is. Okay. So, that was actually one Tom and I did, our very first one. I called the instructor of an investment class that we took, very similar to this, except we were not social distance. We were in a packed room in a hotel. And I called him weeks later and said, I have a question. Like, is it legal to like make a profit on your investment? Or, because he was teaching, even if you have to take a loss every month, go ahead and buy something. Like, that's what his material was. If you have to be in the negative, go ahead and just invest for the depreciation alone and the tax benefits. That was kind of the mantra. So I was like, if we make money on this, is this illegal? Like, is this okay? And he was like, are you kidding? So the criteria obviously is positive cash flow, because you don't need to go negative.
Yeah. Property management versus self-management, pros and cons there, of course. Some people like to do the self-management and be hands-on. Other people prefer to just let somebody else deal with the tenant calls and the rent collection and the potential late fees and all of that stuff. We do personally have a property management company and offer that to our clients, more so as a resource. If they don't want to do it, we've got the experience, we can do it. If they want to do it themselves, we can help with just finding the tenant and then turn it over to you, and then you manage the property. if you want help in just securing that tenant and getting the lease written properly and all that stuff, we can do just that. So mentioned early on, read the Millionaire Real Estate Investor book. You want to talk to a mortgage professional if you don't already have somebody that you trust and would like to connect with us. We can certainly point you to some great folks that can help with that, so you can understand what you can do. And if you have a financial advisor, involve them as well, so you can understand. There are some changes right now with what's going on with the virus that would allow you to tap into some retirement if you wanted to. I'm not saying you should do that. That would be something to have a conversation with your financial professional about. And then, obviously we'd love to help you and move this forward. Our team is 9 folks. We've also got Jamie on our team does project management. So if you find that fixer-upper and it seems a little daunting, she manages the contractors and can help with all of the selections as to what to put in there to just make it awesome, and do that within a budget. So that's part of our service with our clients as well. And then I mentioned the property management, that we can either just help you find and qualify and place the tenants, or we can do the full property management as well.
Mm-hmm.
So we want to stop there and see if anybody on this has questions. You're certainly welcome to follow up afterwards, or if you're watching this recording later, then reach out to us through our website as well.
Yeah, and I'll just put it, the market's changing all the time, and Tom and I are coming, and our team are coming across properties, new ones every day that could be a possibility. People are coming to us with questions, and we do have someone that just reached out recently that unfortunately lost their job, and they have they've actually not been charging the right rent. I think the rent for their house range is $1,500 to $1,600 a month, and they have a friend who's been staying in there for about $1,000 a month. So his mortgage is about $1,300 a month, and now he's in the whole $300 a month while his friend's been living there. So anyway, there's obviously lots of equity in a property like that he now wants to release and move to another situation. So with his situation, it means nothing more than this is a rental that now I need to sell. The tenant could be moved out. The rent capacity is available. So that is right now a situation. So that and many more, I think, are going to be opportunities to, and it would be an opportunity for this particular person, because he's got equity that he needs to release. So he will be able to use that money in a different way. And I think he's had this home for over 14 years. So.
Yeah. Well, thank you all so much for joining us. I'm going to actually stop the recording now. And so thank you for coming. I'm going to stop it, and we'll stick around for another minute. If you want to chat with us and just didn't want to be recorded, then we're happy to.
Yeah. Thanks, guys.